Okay, so today we're going to be talking about how buyers and borrowers can buy down points. This is just for information only. I'm not a loan officer. These are going to be examples given, and this is just for education purposes only. If you have any questions, please reach out to us or reach out to your lender and ask them any questions. So what is buying down points? Buying down points, if you look on the screen here and you want a copy of this, let me know and I will email it to you. But buying down points, it means that you pay to lower down your interest rate. It's usually a one-time fee that you pay, and that's usually done at closing. I will also say this again at the end after I explain what it is. That way it makes a little bit more sense. But either the buyer or the person refinancing can do this to lower the interest rate. Now, market conditions, type of loan, these kind of things will cause variations in how much it costs and how much you have to pay and how many points you can buy down. Okay, so now that we know what buying down point means, why do it? Why even pay money to lower down an interest rate? Well, for example, in today's market, I believe, just to give you guys an idea, the interest rates are at about 7.3, 7.5. I would say about 4 or 5 months ago, they were about a 3%. So that can mean a great deal of difference in your mortgage payment. But here are going to be some examples as why it's a good idea to buy down points. And this is not for everyone. It's not for every buyer. It's not for every person refinance. But it is out there, and a lot of people don't even know it's out there. A lot of people don't even know, either buyers, some agents don't even know that this exists. So it's very important for the public to know that these are options out there for people who are buying property or for people who are refinancing their property that they already own. So what are the reasons that we do this? Well, the main reason why this is done is to lower down your interest rate. Well, why lower down your interest rate? Well, it lowers down your monthly mortgage payment. Obviously, for obvious reasons, everyone wants the lowest monthly payment possible, but sometimes buyers have to buy down the point. What does that mean? If their debt to income ratio, or DTI, exceeds the guidelines of the lender, sometimes if the buyer buys down the interest, buys down the interest rate, now they can qualify for the loan. So what's debt to income ratio, or DTI? It is the debt, your total debt that you have, including credit cards, including car payments, including your mortgage payment, everything that's on your credit on a monthly basis. Okay, it's your total debt, and you divide that by the income. That gives you the debt to income ratio. Okay, now depending on the type of loan that you or your customer have, for example, conventional, FHA, VA, USDA, etc. It depends on the type of loan in the bank, varies what you would qualify for. Just to give you guys a little bit of an idea, those range between 36% to 50%. Okay, so what does that mean? If, let's say, the max is 50% and your debt to income ratio, or DTI, exceeds 50%, so let's say it's 60%, you do not qualify for that loan. Whether you have great credit, whether you have great down payment, whether you have everything else that you need in a package to qualify for a home, if your debt to income ratio exceeds the bank or lender's guidelines, you will not qualify for that loan. So just to give you a little bit of an example of how to calculate this roughly. Now, always go to a loan officer for this. There's different things that they can come up with to help you lower down your debt to income ratio and qualify for a property. And that's why we're talking about buying down points today, because home values in our areas today are very high, and these kind of things are some ideas of what buyers can do to increase their sale price and reduce their monthly payment, and in turn help them qualify for a purchase. So for example, let's say the monthly debt is $2,000. Okay, This includes everything on your credit. The future monthly payment that you're going to have for your mortgage of the property you're purchasing, credit cards, car payments, anything that's on your credit, okay? So let's say that's $2,000 and the total income that you make is $6,000. There's scenarios on this as well. So this is for W-2 employees or self-employees after they have paid their taxes. So if you're self-employed, this gets a little bit more difficult to calculate. But let's just say you've already done that calculation and your total income is $6,000. If you divide 2,000 by 6,000, you get 33%. That is what the debt to income ratio is. That is what we call a DTI, short version. Okay, now, if you go back up to what we were saying, that some lenders, if you pass 50%, don't qualify you, this is how they calculate this, okay? So, if you meet all the other criteria and your ratios are 50% or less, you can qualify for a loan. Now, if they exceed that, that's when buying down points matters, okay? A lot of agents are starting to do this, and now in this market, as well as having sellers pay for seller contribution, they're paying down points, and they're buying also down the interest rate in order to increase, obviously, the sale price and the amount that the buyer will qualify for. If these things are not done, sometimes the buyer cannot qualify. So it's just kind of unfortunately what's happening now because of how high the properties have gotten. Now, who can pay for this? So typically the buyer pays for this. It is a one-time fee paid at closing. I'm going to give you some examples of the cost. This cost varies depending on the market rate of the day and depending on who the lender is and who it is you use. But I'm going to give you an idea just so you see how, to apply this. This is just for your knowledge. You should not be telling any customers this because it's not our job. Okay, we are realtors, we're not loan officers. Let the loan officers do that. But it's good for you to know, because if your buyer doesn't know this, you can say, hey, listen, you can buy down the points, ask your loan officers how much it will cost you, etc., etc. If you're using a good bank or a good loan officer, they will know that this can be done, and they'll be able to explain this to your customer. However, good to know. So who can buy the points down? The buyer can buy the points down. Like I said, it can be done at closing one time. The seller can also pay for the points. So in the initial offer, when you put in the offer, if you tell the seller, I'm going to pay, full price on the property. However, and you need to be careful how you word this, but however, I want you to pay for, if you're the buyer, I want you to pay, let's say half a point to buy down my interest rate. Well, that can be done, but you have to negotiate that at the time of the offer. You cannot negotiate that later. So it's important for you to get with your realtor, and it's important for you to get with your loan officer and talk about, what do I need to do to make this happen? And they'll tell you, okay, you need to buy down half a point or a point or 3 points. We had a closing that bought down 3.3 points or something like that. So it just depends on the scenario and the debt to income ratio, what type of bank, what type of guidelines and everything. But it's good to know that it can be done. Builders, if you're buying a new construction home, builders also are good at giving incentives depending on if it's a seller's market or a buyer's market or what's happening in the area. They will also be willing to buy down on the interest rate for the buyer, but again, that has to be done as part of the initial offer. Usually you can't negotiate that afterwards. Okay, so buyers, sellers, and builders, typically loan officers and realtors don't kick in part of their commission for that, even though it could be done. Just so you know, it can be done, but that's not the case. That's not usually how it goes. Okay, so what is the cost of buying down these points? So these are just examples. This can vary from lender to lender. It varies on what the market rate is today, but I just wanted to kind of give you an idea of what would be the cost if you're buying down points. So it can cost you anywhere from a quarter point to half a point to improve 0.125. points on the interest rate. So all of this calculation is based off the loan amount, not the sale price. There's a lot of different things that are based off the sale price. This is not one of them, because if you're giving 50% down, there's no reason for it to count against your sale price if you're only getting a loan on 50% of it. So just remember, this is based on the loan amount. So let's just say your loan amount is $250,000 and you want to buy, you only want to buy down 0.125%. If it costs you, depending on what the prices are for the lender that day, if it costs you 0.25%, just to give you a dollar amount, the cost of that would be $625. If we're doing half a basis point, the equivalent to that would be $1,250. So that to us kind of doesn't mean anything, except we only look at one number. Okay, it's going to cost $625, or it could cost $1,250. But what does that mean to the typical buyer? Let's just say that the typical buyer gets a 6% interest rate. If it costs them $1,250 to buy down 0.125%, it brings it down to 5.875. Still doesn't mean too much, except, okay, I got a better interest rate rather than 6% versus 5.875. This is what means something to buyers. If you're paying $1,782 with 21 cents on a 6% interest rate. Now, this depends on the sale price. This depends on the down payment, loan amount, property taxes, if it has HOA, if it's in a flood zone, what type of insurance. So this is just examples. You have to do your own math on your own properties. But if you were to pay, $1,700 on 6% interest rate, you would save about $20. So if you buy down from 6% to 5.875%, your new payment will be $1,762 with 18 cents. If you look at that, you're like, oh, I don't know if it's worth it. This is the time where you have to calculate, okay, what is it worth for you? Is it worth for you to pay 6% for 30 years if you're getting a 30-year loan? Or is it just worth to buy down and pay $20 less a month for 30 years? You have to do that calculation and see what it's worth to you. However, let's do a little bit bigger numbers, a little bit more realistic numbers. If we have today an 8% interest rate and we buy down to 5.875%, now what would be the difference in mortgage payment? Well, monthly mortgage payment with these same above numbers would be $2,117.74. We buy it down to 5.875%. Now our mortgage payment is $1,762 with 18 cents. That's a big difference. That can make or break a deal. That will reduce the debt to income ratio by about $500, and it would increase their buying power or the sales price by a lot. So this is actually when this is done. Normally to save $20, people don't do it because it's not worth it to them. Sometimes it is worth it to them, but you have to see the circumstances for each situation and for each case and see. Now, you cannot say, oh, you know what, today the interest rate is 7.5%, I want a 2%, and then just buy down those points. There is a limit to how much you can buy down, and it depends on many different things, including each lender, the guidelines, the type of loan you're getting, the type of program, who's backing the loan. So that's why this is just for educational purposes, just so you get the quick idea of what to do if you're buying or you have a customer that's buying, how to kind of quickly explain to them that this is an option. But we are not loan officers. We should talk to professionals and have loan officers answer any and all of these questions. Now, there is 3 different type of buy downs that you can do. It's not the best one is the one that's fixed for 30 years. So I'm going to start at the bottom for this one. So let's say you do the above. You go from 8% to 5.875%, and it costs you X amount of dollars to buy down that interest rate. Well, when you do it for 30 years, let's say that you can do a 15, 30, or 40-year term on a loan, but the typical is a 30-year loan. So let's say you're doing a 30-year loan, okay? And you do the buy down at a fixed rate for the whole entire 30 years. You're gonna have the same exact interest rate. So instead of getting the 8%, you're gonna have 5.875%. Perfect. That's my favorite one. That's the best one. That's the most popular one. However, there's others. There's one called a 2-to-1 buy down. That means if originally, let's say you were getting 8% and you got the 2-to-1 buy down, we're gonna use a little easier numbers. The first year you would pay 6%. The second year it will go up 1%. So then you would pay 7%. And then the third year through the 30th year, depending on what term of loan you got, then you would pay the 8%. Now, I don't like that because at the end you're still paying a higher interest rate, but sometimes this is less expensive to get, but you can still qualify at a higher sale price. I prefer to be low fixed forever and just pay more upfront than later, but some people don't have the money to buy down all those points because it is more expensive to do it the fixed way. The 3-to-1 buy down, it's the same idea as the 2-to-1, but except for 3 years. And it usually starts at a lower interest rate. So you would start, let's say, off at a 5% interest rate. Then the first year, after the first year goes up, to 6%. Then the third year, the second year goes to 7th, and then the third year goes to 8th, and so on. And then from the 4th year to the 30th year, it's fixed. So this is a little bit on buy down and buying down points. The other important thing to remember too about interest rates is once you have an executed contract, or once, if you're refinancing, once you start the loan application with the lender, you can lock your interest rate. If you know that interest rates have been going up since March, and you're like, I don't want them to keep going up, well then you can lock your interest rate for a certain determined amount of time. So let's say your lender says we're supposed to close in 30 days. You can lock your interest rate for 30 days. Now, you cannot let it expire. If it expires, once you have that first lock, it's a free lock. There's no charge, no fees to you. Once you reach that 30th day, on that day that your interest rate expires, if your lender does not extend it for you and it expires, you will not get that interest rate. But if they do extend it, there is a fee that you will have to pay one time at closing to extend that interest rate. I don't want to get into the specifics right now because that varies greatly, but I just want you to know that it is an option. Agents, make sure you're writing these things down with your contract dates. Ask your lender, hey, when does my buyer's rate lock expire? Write it down and make sure the day before you're reminding the loan officer, if you're not closing on that day, hey, we need to extend it. Now, if you think you're gonna close within the next 7 days, then lock it for the next 7 days. But if you're not sure and you think you can close in the next 3 days, only lock it for 3 days, because the amount that it costs you to extend it for 7 days, you're not getting back and you're having to pay at closing. So if you close in 3 days, you're still paying for a 7-day extension on the interest rate lock. So it's better to keep extending little by little than extend it for 30 days and then having to pay for an extension of 30 days, but only using 15 days of it. So it's a little complicated. Ask your lenders about it, and agents, don't get too involved in this. It's just to help your customer, your buyer, not have to pay more fees than they already will have to pay. It's just our job to stay on top of the loan officer and tell the buyer, hey, your interest rate expires today. Remind your loan officer, you guys have to extend it, and kind of have open communication with everyone, because it is very, very important that it gets locked. Some buyers, if their interest rate is not locked because the interest rates have increased so much and they're going up so quickly, they will not qualify for that home. So it would be very sad if your buyer has been waiting for a month or 2 or 3 to close, and then all of a sudden, because a couple people didn't do their job, then now they can't qualify for the house. So just make sure that you guys are on top of all your contract dates, on top of all the extensions and anything that expires. And these are the reasons why we do it, to kind of help our buyers, help them save money, and help them stay on track. And everyone's goal at the end of the day is, let's make it to closing and let's get everything closed and have happy buyers and sellers, right? Does anybody have any questions? No? All right, so this is the end of it. If you have any questions or you have anything you want to add to it, just let me know. And that's it. Thank you. Thank you.